Everyone wishes they could have bought Microsoft back in the 80s. If you had invested only $1,000 in 1986, you would have over $4.3 million today, not to mention over $300,000 in dividends. Let's look at Amazon. If you had invested that same $1,000 in Amazon in 1997, you would have over $2 million today. So, how can you find the next Microsoft or Amazon? Well, it turns out it's not that easy. Wall Street intentionally makes it difficult for small retail investors like us to find these great opportunities. But in doing so, Wall Street is actually telling us an even bigger secret about the market, but only if you know where to look. So let's journey back to 1986 and see what Wall Street was secretly trying to tell us. Before we talk about Microsoft or Amazon, we first need to answer the question, how do new stocks get on the stock market? Wall Street introduces new companies to the public through IPOs, or initial product offerings. This is where a private company partners with a large Wall Street bank, creates shares of this private company, and then the bank sells those shares on the stock market. So, back to Microsoft and Amazon. Microsoft's IPO was March 13th of 1986. Let's look at the S&P 500 during this time. In 1982, we see that the market hit a bottom and then had a strong bull run for the next several years. During this bull run, we see Microsoft had its IPO when the market was on track to hit an all-time high. Let's fast forward to 1997 when Amazon went public. We see Amazon was also released during a strong bull run. The S&P 500 was hitting new all-time highs every single year leading up to Amazon's IPO. So, is it a coincidence that both Microsoft and Amazon were released during such a strong bull market? Not exactly. Let's look at a little more data. Here we have the AAII Investor Sentiment Survey in 1986. This survey measures how investors feel about the market and shows percentages for bullish, neutral, and bearish sentiment. We see in 1986 that investor sentiment was at 66% bullish, one of the highest ratings ever. Fast forward to 1997 and bullish sentiment is at 63%. So what does all this mean for Microsoft and Amazon and the market as a whole? Let me throw in one more data point to tie this all together. When Wall Street brokers sell shares of companies, they make a commission on those sales. When they sell old common shares, or shares of a company after its IPO, they make about a 4% commission. But when they sell shares of a new company during their IPO, their commission is as high as 8%. That's almost double the usual rate. Now, basic economics tells us that when demand is high, sellers can often charge higher prices, and that's exactly what Wall Street does during IPOs. They release hundreds to thousands of IPOs when the market is experiencing two key things. The first is a strong bull market, and the second is high bullish sentiment from investors. This allows Wall Street to jack up the prices on these IPOs, sell them when there's a lot of hype and excitement around the market, and then make astronomical commissions on them. Don't believe me? Back in 1986, there were 393 IPOs released by Wall Street that year. Today, we only hear about 3: Microsoft, Oracle, and Adobe. In 1997, there were 474 IPOs, but the 5 that we hear about today are Amazon, Polo Ralph Lauren, Hertz, Thrifty, and TD Ameritrade. 1 year prior, in 1996, Wall Street did a whopping 677 IPOs, but none of those companies are even close to the market cap of the select few from 1997 and 1986. So why did so few companies make it through to 2025? The answer is because Wall Street sold them at such a high valuation during their IPO that it was almost impossible for all these companies to keep up. After their IPOs, investors started to see the true financials of these companies. They were reporting low earnings, low revenue, and slow growth, like most new companies do. But Wall Street valued these companies at such a high price that when investors found out about their true value, they panicked and sold all their shares. In fact, It's this high valuation pricing during IPOs that leads us to Wall Street's secret message. To finally uncover this message, let's go back to 1986 and expand the picture a little bit. Microsoft's IPO was March 13th, 1986. Just over a year later, we saw the single worst day in the market on October 19th, 1987, now known as Black Monday. Fast forward to the bull market of 1997. Just a couple of years later, we entered one of the most extreme bear markets ever during the tech bubble crash. This crash took over 6 years to recover from, and then we got hit with the great financial crisis in 2008 and 2009. You starting to see a pattern here? As Warren Buffett said, be fearful when others are greedy, and greedy when others are fearful. So what is Wall Street trying to show us? They're showing us the power of their greed. When Wall Street starts getting greedy and wanting more and more money through IPOs, it's a good sign to investors that the market is reaching peak valuation. When companies and indices are overvalued, especially to the extent that we see during IPO booms, it's only a matter of time before a correction or a crash comes. So what can we learn from this? We can take away 3 main points to help guide us as an intelligent investor. First, never trust IPOs. If you think you're getting a good deal, imagine what Wall Street is getting. Second, beware that IPO booms often signal an upcoming peak in the market. Now, don't use this to try and time the market, but rather be cautious with your investments and pay particular attention to companies' valuations. And third, if you must buy an IPO, wait a couple of months before you do so. In most cases, IPOs see a surge in price immediately following their release that lasts for about a couple weeks at most. After that, their price usually drops below the initial IPO price. So be patient. If this is a strong company, you will find a better buying opportunity. IPOs can be enticing. The potential of finding the next Microsoft is enough to make most investors cave and buy this new company. But don't be fooled. Armed with the secrets of IPOs, along with a little patience, you can avoid making a horrible investment decision that's based entirely on emotions. So be smart, be patient, and happy investing.